What is up, YouTube? On today's episode, we're going to go through the TSP for beginners. We're going to start off by going through some of the basics of the plan, go through some of your contribution options and making sure you're getting your maximum amount of match. And then finally, we're going to go through the biggest decision you have to make when starting your TSP, which accounts for up to 80% of your investment returns.
Where did you...
Hi guys, my name is Kevin Alf from Infinite Wealth. On today's TSP for beginners, we're going to go through several different things. First off, we're going to go through your TSP asset allocation. There is some information on the tsp.gov website for you. If you go to Planning and Tools, Living in Retirement on top, and then select Asset Allocation, you can read about some of the asset allocation. That doesn't give you a huge amount of information, but you do want to start there, look at everything on the website. In a little bit, we'll go through a couple different things of ways you can make your most important decision, which is your asset allocation. And the basics of this is just a percentage of your stocks, bonds, and cash in your portfolio. And studies have shown that this can account for up to 80% of your investment return. So this is a decision you do not want to take lightly. Now, the first thing we're going to go through today is TSP matching. Whether you put money into the TSP or not, you will get a 1% automatic agency contribution. And then you can choose a percentage of your income. If on your first 3% that you elect to put into your TSP, you'll get a dollar for dollar match. So on your first 3%, your match will be 3%. Then on the next 2%, so at 4% and 5%, you are 50 cents per dollar of match. So to put that in simpler layman terms, by contributing 5% of your pay, you're also getting a 5% match. So you are doubling your money, or you're getting a 100% return on your investment. You will not find that anywhere else. You will not make that money anywhere else in the investing world. So please, you have to figure out a way in your budget to get up to the 5% into your TSP. And then by that way, you're saving at least 10% of your income. Now, a lot of people do choose to put more in their TSP. It is 2019. So as of this year, you can put in up to $19,000 per year into your TSP. Now, there is one thing you have to think about with matching. If you fund your TSP before the year is up, you do not get a match if you don't actually have a contribution to your TSP in the pay period. So an easy way to calculate it out, if you want to max out your TSP, most years there's 26 pay periods. So this year is one of them. So you take 19,000 divided by 26, rounding off, that is $731 per pay period. So if you're contributing $731 per pay period, that'll be times 25. Your last pay period will be $725. So you'll have the full $19,000. You will contribute every paycheck during the year, and you'll get your maximum amount of match. There are many people that do contribute this $19,000, but if you do it too soon, you are losing out on free money from the government, and you do not want to do that. And next up, we're going to go onto the Vanguard.com website, and I'm going to walk you through a risk tolerance survey to help you determine your asset allocation. Okay guys, here we go. We're on the Vanguard.com website. Now, the reason I chose this website, there are many other asset allocation calculators out there, but the TSP plan is an index-based plan, so we will talk about that more in video 2. But Vanguard is primarily known for their index funds, so this will be a good estimator for an index-based plan that you can use. Don't worry if you don't have an account. You'll just go to the Vanguard.com. If it's your first time, it'll probably ask you if you want to be a personal investor or institutional. Just pick personal. Under Advice and Retirement, go to Choosing Investments. And then they're going to start with your asset allocation. That's what we're trying to determine here. So go ahead and just read through all this stuff. It's going to tell you about asset allocation. Vanguard's reporting up to 88% of your investment returns are on your asset allocation. My figures are, I've seen anywhere from 75 to 90, so that's probably a fair number. So we're going to answer the questions on the questionnaire. We'll just go through a couple examples for hypothetical. Let's see. First example, you plan on taking money more than 15 years. As you withdraw from these investments, you plan to be retired for more than 15 years. That will be most people. When making a long-term investment, this is asking about how soon you'll need the money. I picked more than 8 years. If you're anywhere less than 6 to 7 years, you probably don't want to have your money in the stock market. So just keep that in mind. This question is about what you would do if the stocks went down 31%. So you kind of have to ask yourself that. If you're a new investor, you might not know. But just for me, I would hold on to the investment and sell nothing. So just stick to the plan. Generally, I prefer investments with little or no fluctuation in value. I would disagree with that. During market declines, I tend to sell portions of my riskier assets, invest in safer assets. I would disagree with that. I would invest in a mutual fund or ETF based solely on a brief conversation with a friend. I disagree with that. I do not invest in anything that I don't understand myself. This is bonds lost 4% in 2 months. What would you do? I would hold the investment, sell nothing, stick to my written investment policy statement. That will actually be video number 3. The chart below shows the greatest gains and loss. So the way I look at this, for $593, you're risking $164 for the potential to make $593. So that's a small risk for a pretty big gain percentage-wise. All the way to C, where you're risking to lose $3,000, that's $639, and making $42.29. I would pick B. I'd risk losing $1,000 to make $2,000 approximately. To me, that's a better deal than risking $3,600 to make $4,200. That's almost a $1 to $1 bet. Current and future income sources, Social Security. If you are a government worker, you will have a pension if you're there long enough. And your current income should be stable since you do work for the federal government. So I'd either say stable or very stable. When it comes to investing in stock or bond mutual funds or ETFs, I would describe myself as, I'm very experienced, but just for this example, we'll say somewhat experienced because you guys are trying to learn it for yourself. And I just made up a allocation here. This would be what you currently have if you have any money invested now. You just click Get Results. And then up at the top here, it's suggesting a 20% bond, 80% stock portfolio. So like I said, I would never recommend that you have any less than 20% bonds. So 20-80 would be the minimum I would go. So let's go back and do a little different example. Let's say you're less experienced. So let's say you're getting close to retirement. You're about 5 years out from retirement. You're going to be in retirement for 15 plus years. So now you're 5 years out. So you're planning on keeping some of the money invested for 5 to 6. So let's just pick that. We'll pick buy more of the investment. We'll disagree with that. Disagree with that. Strongly disagree with this, assuming you're a more experienced investor. Let's see, pick buy more of the bond. We're getting close to retirement, so I think we want to minimize our loss. We'll pick that one. You'll say very stable, because if you are getting ready to retire, you probably have your pension locked in, your Social Security planned out, and all that, so it should be very stable. And we'll just pick very experienced. We will say 10% short-term reserves, 40% bonds, 50% stocks. So on this one, since you're still showing that you're a more aggressive investor, getting close to retirement, it would recommend a 40% bond, 60% stock portfolio. Now these are just a starter number if you don't really know at all what your number would be. Next thing that I would do after you get this kind of gives you a baseline number. And then we're going to look at this compared to some of the other asset allocations. So this is some Vanguard portfolios. So this will give you an idea of the average annual return. Keep in mind that it is 2019 and we've had about an 11-year bull market. So some of these numbers are probably a little inflated. And I always recommend having at least 20% stock. So this would be the lowest portfolio I'd recommend. As you're going up in percentage of stocks, you will see that the average return increases as you increase the percentage of stocks. So your best year will increase, and then your years with the loss, as you have more and more stocks, you have more of a chance of having a year with a loss than the stock bond mix. So let's look at the two examples we were at. So we were at a 60-40 stock bond mix was one of the suggestions. Average annual return of 8.8% over about the last 90 years. Best year was 36.7. Worst year was minus 26.6. Lost money in 20 of 92 years. So that's about 1 out of 4.5. So the other one it suggested, the first one was my suggestion, was 80% stock, 20% bonds. Average annual return 9.6. So if you look at that compared to 8.8, you're getting more of a compounded return there. Best year 45.4 versus 36.7. And then also your worst year is bigger with the higher stock portfolio. So it's minus 34.9 compared to 26.6. And then you have 3 more years that have potential to have a loss. Now you always have to take looking back at historical data with a grain of salt. Markets do never repeat themselves, but if you look at your portfolio and you know that it's lost, you have an 80% stock, 20% bond, and it's lost 34.9% in a year in the past, I would take that as the minimum loss that you should figure in. So you always want to think about that. If you had a $100,000 portfolio, you'd lose $35,000. So with a year, you would watch your portfolio go from $100,000 to $65,000. Always think of it in terms of dollars. That helps you make a better determination on what portfolio is right for you. So you can see the big difference here. So worst year here, 26.6. So you'd watch a $100,000 portfolio would lose roughly $27,000. So it'd go from $100,000 to $73,000, which is quite a bit of difference. So you can kind of play around with this, look at some of the numbers. This will just help get you some idea of where you want to be for asset allocation. And then there'll also be the other tips that I give you to help determine your asset allocation.
Okay, I hope that was clear to you on the Vanguard site. That's kind of an easy way. It'll kind of give you an idea of your risk tolerance, where you want to set your asset allocation at. Your asset allocation is just a complicated financial term for saying it's the way of splitting up your investments between cash, bonds, and stocks. Now the percentages of each one of these will determine up to 80% of your portfolio's return. So you do want to take some time, make sure that you get the right asset allocation for you. We did look at one way to determine your asset allocation on the Vanguard.com website. There are several other rules that we'll use to determine our asset allocation. First off is you should never have less than 20% in bonds, and you should never have less than 20% in stocks. So what that is saying is that you should never have a portfolio that doesn't have at least 20% of bonds and 80% stocks if you're younger. And then as you get older, you should never have a portfolio that has more than 80% of bonds and 20% of stocks. Now another way we can think about our asset allocation from a risk perspective is we take your percentage of stocks in your portfolio, divide it by 2, and that'll give you a rough estimate of the maximum amount of percentage loss you can get in a market downturn.
So for example, I have an 80% stock, 20% bond portfolio in my TSP. So on a really bad market year, you would expect to see a 40% loss because you take your 80% in stocks, divide it by 2, that gives you 40% loss. So the way you want to think about it is if you had $100,000 in your TSP, would you be willing to watch your account go down to $60,000 and not change the way that you're invested? If your answer is no, that means that your stock percentage is too high. You need to lower it. So another example is if you had a 60% stock, 40% bond portfolio in your TSP, take your 60% stock, divide it by 2, that would give you 30%. So if you had a $100,000 portfolio in a severe market downturn, you'd watch that portfolio go to $70,000. So that is a big difference for a lot of people. So that is another thing you can kind of do as to a rough way to help you decide what your asset allocation should be. Now, as we get older, we want to have more and more bonds as we get closer to retirement. Now, your final way to determine asset allocation is to use a 120 minus your age, and that'll give you your percentage of stocks. Now, this first one is for people that are risk tolerant. So myself included, I would use the 120 minus age because I've been an investor for a long time. I know I'm a risk tolerant investor. I have a long time horizon, and I know I can stomach and weather out any of the market downturns. So for this example, 120 minus 40 years old would give you 80. So that would give you 80% stock, 20% bond. 120 is a pretty big number. So if you don't know that you're extremely risk tolerant, some people use 110 minus age. So if you were 40 years old, 110 minus 40 would give you 70% stock, 30% bond. And then finally, if you're just a brand new investor, just starting out, a lot of people will use 100 minus their age. So for example, if you're 40 years old, 100 minus 40, that would give you 60. So you have 60% stock, 40% bond. Remember, think about in a market downturn, that portfolio could lose roughly 30%. So your $10,000 balance would go to $7,000 balance. And then finally on asset allocation, we haven't talked about cash yet. Now for most younger investors, you don't really need to have a component of cash in your actual portfolio. But people that are 5 to 7 years away from retirement, you need to start thinking about how you're going to have a cash component in your portfolio, because the worst thing that can happen to you is you're a year or two away from retirement and then you have a severe market downturn where you lose 30, 40, 50% of your portfolio. Well, you don't want to sell your investments when they're down that low. So what you start doing is when you near retirement, you build up your cash position. So you have anywhere between 2 and 5 years of cash on hand so that you just sell money out of the cash account. Now that would be your G fund in the TSP. So as you're getting closer to retirement, just make sure that you're thinking that through. So you might want to add an allocation to cash. As you're getting closer to retirement, you're going to have a higher percentage of bonds, lower percentage of stocks. Now if you're 20 years old and just starting out, you probably want to have an 80% stock, 20% bond portfolio. Over time, studies have shown that that 80-20 portfolio will return over long periods of time, 10 to 15 year periods, will return just the same amount as a 100% stock portfolio, but it'll be less volatile. So that means that it will go up and down less violently. So in a severe market downturn, it's not going to go down as much. When the market is taking off like it has in the last 10 years, it will also not go up as much. You will get more of a steady climb, but you will end up at the same place as a 100% stock portfolio. Now the final thing I want to talk about is you do have a TSP Roth option. Now is that TSP Roth going to be right for you? Well, you'll kind of have to make that determination. If you anticipate that your tax percentage will be higher in retirement than it is now, then you'd want to go ahead and do the TSP Roth. So if you actually do the TSP Roth, you will pay taxes on your investment now. So if you do a $5,000 into a TSP Roth, you will pay $5,000 of taxes at your income tax rate for federal and state now. As that money grows over time, you will be able to withdraw that money tax-free in the future. Now this only works out to your advantage as if your tax rate goes up in retirement compared to what it is now. So you do have to really think that out. There's a lot of unknowns in the situation. I personally do not do a TSP Roth. My wife is the government worker. We fund her TSP up to the $19,000 per year. So we do $731 per paycheck. And then in our Vanguard account, outside of the TSP, we do $5,500 into a Roth IRA, which is the maximum you can do for 2019. And then what I feel the advantage is on this is that at Vanguard you have many more investment options. You're pretty limited with your investment options, although they are good options in the TSP. If you do invest with your Roth outside of the TSP, you do have a lot more investment options. So I like to keep that open for myself. Then one last thing on the TSP Roth. I don't do one, but from all the research I've done, so if you do 5% on your TSP Roth, your 5% match will go into a regular TSP. So that will be taxable on withdrawal. So I know we've kind of went over a lot of information today. Just to sum up everything we've went through, your most important decision you're going to make on your TSP, which will account for up to 80% of your returns on your investment over time, is your asset allocation. So you want to take some time, make sure you get that right for you. So that is the percentage of your portfolio that's allocated to stocks, percentage to bonds, and percentage to cash if you have any in cash. Then the second most important thing today is getting up to that 5% level so that you take full advantage of the 5% match that the government does give you. That is 100% return on your money, and you want to make sure that you are taking advantage of that because you will not get that anywhere else. So that wraps up part 1 of the video series on the TSP investing for beginners. In part 2, we're going to go through each of the different investment choices we have for the TSP. In part 3, it's going to get a lot more fun. We're going to actually build your portfolio custom tailored just for you. And then in part 4, we're going to go through some of the things that you have to do to maintain your portfolio over time. It's all pretty simple. I spend probably 30 minutes every 3 months on my TSP, outside of the few hours that I spent to develop my portfolio in the beginning. I want to thank you for watching this video today. If you do have any comments, please leave them below. I would appreciate it if you hit the like button, subscribe, ring the bell. You'll get notifications of future videos that I'm going to put out. And again, thanks for watching. Look me in the face, tell me that you love me, even if it's fake.